Okay. So as I just said, I'll make sure I see everybody here. As I just said, warranty is a cost for every unit produced years 1 through 8. Well, what the company has done, it says, okay, we're going to give anybody who buys our motor, our electric motor, we're going to give them a 5-year warranty. So we have to analyze and determine, okay, how much are we going to allocate, set money aside as an expense to pay for this estimated warranty? Well, they give you the numbers. For CTX 13, it's $165 a year for 5 years. For MT 78, it's $175 a year for 5 years. So you're now calculating 5 years of costs every year, 165, 175, over 5 years. Now I would build inflation into that number. And then, here comes Peter, he's late. And then I would discount that number, those 5 years of cash flows back into one number. And that one number then will be multiplied, because now you have included the inflation in the calculation, and that one number will be multiplied times 40,500 units produced every year, and that's your total dollar amount every year. And you've included inflation in it, so I don't have to worry about inflation in that putting it into my analysis. That's why I said way back when you should create a separate line, variable cost for warranty, because that's a different calculation than the other variable costs that are per unit, but you are going to inflate those costs over the 8 years. You're already inflating the warranty costs in your present value analysis. Damn, and I thought MBA would be easy. So that's what I'm looking for. So that's when I made that comment a few minutes ago, that your warranty total dollars per year should be quite a bit north of $20 million a year. That's how you come up with those numbers. Your job as the analyst is to determine that discounted cash, that cash flow over 5 years, discount it to a present value for the one number, and that's what you allocate every year for 8 years. I hope that helps.
Yes, thank you very much.
Okay. Alexandra, you just came on. Can I answer any questions for you? I am recording this session.
I think just in regards to the WAC that I went ahead and sent you, I know that you mentioned that the interest rate was incorrect on my part, but in terms of the percentage of equity,
Yes.
Can you just go ahead and expand on that?
Yes, we did that a little bit earlier. That was one of the first questions we had, but that's okay. There's no worry about that. Alexandra, if you take a look, I've given you in the case, you have your risk-free rate. It's given to you in a little bit different wording, but it's the risk-free rate. I've given you your market premium, so you don't have to worry about market rate. I give you the market premium. I give you the yield on the current interest of the debt, and I give you the beta. The big curveball or question mark for any student or analyst, which you guys are, is, okay, Mr. Hassey, we've gone over the template of determining WAC. Once I determine the after-tax cost of debt, once I determine the cost of equity using the capital asset pricing model, now I multiply that times what percent of debt and equity is the capital structure of the company. Now, we've seen it through all of our class up to this point on any cases or any working class that those numbers have been given to us as 50% debt, 60% debt, and then if you know that, then equity's got to be 50 or 40. But this is what separates the MBA student to graduate out of the 635 class is, can I determine my percentages when it says in the case debt is 50% of equity, not 50% of assets, but 50% of equity. Peter Murray, I explained this to you yesterday. Could you explain this to the class?
Debt is 50% of equity. I don't know. I don't know.
Peter, I gave it to you in an email. Didn't you read it?
I did. I didn't understand your email. That's why I'm here.
Good Lord Almighty. All right, shut up. Turn off your mic. I'll go back to you later. All right, so Alexandra, if debt is 50% of equity, that means on the right-hand side of the balance sheet, assets equals debt plus equity. So debt is 50% of equity. Knowing that, you can determine what percent debt is of assets. And if you know what debt percent is of assets, then you know what equity is because you just add them together and it should be 100%. Now, if you are totally clueless and out of touch with this one, if you go into your searching in the internet and just look for debt to equity analysis, and in that same search, if I know my debt to equity, how do I find my debt to assets? It's so simple. As I said earlier, you're going to go nuts. And here's what I told Peter yesterday. This is exactly what I told Peter yesterday in an email. Here it is. If my debt is $10, remember this, Peter? Just shake your head. If my debt is $10, you know what, Peter, you got to do? Get that goddamn Golden Gate Bridge out of your head. Where just get that thing out of there and put on something different, or just use your regular background. You're getting screwed up being in San Francisco. It's screwing up your mind. Get that out of there. You'll be better, Peter. All right, enough of that. All right, so go back to, here we go. Alexander, this is a biggie. I know, Wendy, this is a biggie. So everybody listen. If my debt is 10%, $10, I have $10 of debt, and my debt to equity ratio is 50%, how much equity must I have? $20, right? $20. If my debt is $10 and debt to equity, given in the case, is 50%, $10 is 50% of 20, right? $10 debt, $20 equity. What's that total? 30 bucks. There's my assets. What percent is debt to assets? I rest my case.
Thank you, Professor.
Thanks, Alexandra. Thanks for calling in. Mr. Murray, did I just answer your question again?
Yeah, you explained it, and
All you're worried about here is the percentages. What do you worry about dollars and stuff? In the WACC calculation, you're just trying to determine what is the percent of this company's debt to assets, what is the percent of equity to assets, and then I apply those percentages to the calculations of after-tax debt and cost of equity. You don't need to know, you don't even need to see the balance sheet. All you need to know is that debt is 50% of equity, and you can come up with the percentages of debt and equity for your WACC calculation.
okay.
No?
I thought you needed to know the numbers.
Why?
I don't know.
I'm using a debt ratio. I'm giving you numbers. The number is debt to equity. That's a viable financial analytical number. Debt to equity is 50%. In this company, Electrics Incorporated, debt to equity is 50%. Knowing that, I know what my capital structure percentages are. I don't need to see the balance sheets. I don't need to see any numbers. I know the company is telling me that their debt to equity position is 50%. If my debt to equity is 10%, all right, watch this, you guys. Yeah, I'll show you something here. Here we go. Hang on. Just a sec. Just a sec. I'm going to show you something. Taking me a little while here, guys. Early. I'll use the whiteboard. I can't access my Excel. Here we go. Okay, watch this. Everybody see my whiteboard? If I have, in my financial statements, all right, I have $1 million of assets. And I have I'll just do it this way. I have $900,000 of equity, and I have $100,000 of debt. There's my capital structure, all right? Well, based on this, we know that the debt to assets is 10%, and the debt to equity, or the equity as assets, is 90%. Okay, cool. But let's say I don't give you those dollar amounts, and I tell you that the debt to equity relationship is equal to 100,000 divided by 900,000. So if I do that arithmetic, 100,000 divided by 900,000, my debt to equity ratio is 0.111. In electric's case, it's 0.5. So I can just tell you that I'm not going to give you the dollar amounts. I'll just say for my business, my debt to equity ratio is 0.111. All right? Okay. So if I have, I'm going to make this simple. If I have, let's say I have $100,000 of debt, I divide that by 0.111, I get $900,000 if I round. $900,000. All right? So that must mean my debt position is $900,000. Or my equity position is 900,000. So I now know 100,000 plus 900,000 is $1 million, but I also know that my ratio of 0.11 means that I can now calculate I can calculate what my asset percentage is. So that's what I'm looking for you to do. And in the case I gave Peter, if I have $10 of debt and my debt to equity relationship is 0.5, that means debt is 50% of something. $10 divided by 50% is $20. So now I know I have $30 of assets equals $10 of debt plus $20 of equity. What percent is debt to assets, equity to assets? That's how you do the problem. I don't need all the dollar amounts or even the financial statements. If I know one ratio, I can calculate out my percentages using that data.
But if you know one ratio, you still do need a dollar amount to
Why?
calculate the equity, right?
No. If my debt to equity is 50%, all right, I can calculate it out just using simple arithmetic. Using 50%. Here, watch this. No, I'm not going to do this. You guys should sort this out yourself.
What?
I'm not doing this. You guys at this level, you guys got to sort this out. I'm not giving you that. All right. Okay. But that's the thinking. If I know the debt to equity ratio, I can just use that number to determine my ratio. And if any of you go to, if you have no clue what this is, just go to an arithmetic book or just go to an analysis and just type in, I have 0.5 of my debt to equity is 0.5. How do I determine my relationship to the assets and equals debt and equity? If assets are one number, I'm solving for the unknown. I'm given 50. Need I say more?
See, that's what
I'm not giving any
I was
dollar amounts.
saying.
What are
Huh?
you saying? It's
I was
arithmetic.
saying, I
I
get
know
it, but I was saying that I would need.
Well, I gave it to you in a dollar amount. In the email I gave you this in dollars. I just made it simple. I got $10 of debt. If $10 of debt is 50% of equity, I must have $20 of equity. Add the two together, there's my assets. That's in dollars. You don't need the dollars of the company. You just need the percent. I'm not asking you for total assets. I'm not asking you for total debt. I'm just asking you percent of debt to assets. Percent of equity to assets. There you go. Cool. Any other questions, sports fans? Peter, question.
I don't have a question. I'm still trying to wrap my head around not needing a number.
Okay. It's all right. If you can't wrap your head around it, just get the friggin' number so you can move on with the case. Because you're wasting, not wasting, you're spending too much time on this, where it's an important number because you need this WAC to do a lot of analysis, but you're wasting your time by doing this. You should just come up with a number. If you can't understand it, that's okay. You'll get it down the road. Trust me, you will, especially when you do the problem. But don't spend too much time with this because it's going to drive you nuts when it comes to Wednesday or Thursday next week, and especially if you come to class Monday night and you still don't have a handle on this. You're going to have a very busy week next week. My topic in class on Monday will have nothing to do with the WAC. It will have nothing to do with the base analysis. It's going to have everything to do because there's a lot of curveballs in your sensitivity and scenario analysis. You got to worry about that. So you need the base case done, you need the WAC done, and then you can now concentrate on your risk analysis, which is scenario and sensitivity, which is a whole nother area of thinking and analysis. Geez, Mr. Hasse, you're really making this a pleasant Saturday for me. Thank you very much. So as I said earlier, just a sec. Go back through this. Remember, there's a checklist that we gave you in Blackboard, and we looked at it in class, a checklist of things you need to do. And a lot of you are well on the way of that, and even finished with a lot of that, is you determine the WAC, you determine the investment dollars, you determine the warranty cost, then you put together the cash flow analysis, you determine the net yearly cash flow, years 1 through 8. Then you do your return analysis. And then once you're done with that, then you have to look at the different scenarios given to you in the case. And the scenario analysis is given to you as your base case is the average analysis with a 45% probability, a weak analysis with a 25% probability, and a strong analysis with a 30% probability. The only difference that we have seen before than this is I give you different prices of the product at those different scenario levels. It's not just $9,200 a unit for all 3 scenarios, which we have seen in other examples. Now I give you different selling prices at weak, average, and strong. So you have to incorporate that in your scenario analysis. All the costs stay the same. The only thing that's different in that will be naturally with your sales changing, your working capital amounts will be different. Everything else is the same. But because you have those now, you see in the scenario analysis 3 different prices, selling prices, and 3 different units sold. That's the scenario. And then the sensitivity analysis gives you the 2 variables. If you look in the case on the questions, looking at question number 7 on page 4 of your case, it says, use the average demand scenario to evaluate the sensitivity of the project's NPV with respect to 2 variables. The sales price, okay, I got that, and the electric motor and the cost of the controller. The electric motor and the cost of the controller. Well, we know the electric motor has a labor cost of $4,250. We know parts are $2,500. That's the cost of the motor. And you also have the cost of the controller, which is for the CTX is $1,280. For the MT, it's $1,260. But you also have to include in that your warranty. So you got to put all those, lump those all together. Warranty cost per unit, parts, labor, and the controller. Put all those together to determine your sensitivity variable for that analysis. That requires a little bit more work. A little you're doing a sensitivity analysis of the entire cost of the product to determine it. Okay? You do not include fixed cost in that sensitivity. There's a helpful hint that'll save you guys a lot of time. You do not include the fixed costs. The sensitivity variable is the cost of the controller per unit, not fixed costs. Don't worry about that. That's a topic for my class on Monday. Get your base case done. You can even do your scenario. Finalize your WAC. Send copies to me this weekend. I can look them over. And then on Monday's class, we're going to take a look at that sensitivity issue where there's two variables, the price of the controller, the price of the unit, which in the base case is $9,200, and the price of the controller, the cost of the controller. So we'll take a look at that in class on Monday, unless some of you have already figured that one out. Okay, that's the end of,
message. Yes. I sent you a private message regarding.
Oh, you did? A chat?
Yes. Yes.
Oh, I didn't see that pop up. Hang on, Peter. Why don't I see that?
I don't know.
Hang on. No, it is not, Peter. It is not. It is not that. You're a little bit south of the percentage. You're a little bit south in as far as debt is concerned. You need to be a little bit higher. Take a look at the email I sent you last night.
All right.
$10 debt, $20 equity, totals $30. What percent is debt of $30? What percent is equity of $30?
Okay.
Okay?
Yeah.
You'll get it. Trust me.
All right.
Okay, good. Any other questions? So wherever you are in your analysis up to this point in time, some of you are just beginning. That's okay. Some of you are pretty far along. This weekend, maybe you crunch the numbers and you send me an email saying, Mr. Hassey, this is my WAC. What do you think? Mr. Hassey, this is my base case analysis. What do you think? And if it looks good, we move on, and you can complete your scenario analysis, do the other spreadsheets for weak and strong. Then you have to do both products, remember, CTX and MT. And then once you got that, then you can tackle the sensitivity issue using your base case or average case. Once you get that done and you take a look at the deltas of the sensitivity issues, now you can complete your paper and write about it. The only additional thing you need to do, and maybe some of you have already done that, is if you look, and sometimes students tend to forget this and then they lose some points. If you take a look, excuse me, at question number 1. Question number 1 has nothing to do with the analysis at all as far as crunching numbers. It has everything to do with why electrics is doing this. How much importance should be given to the energy costs situation? How much importance should be given to the energy cost situations? What is driving the reason why electrics is doing this? That's a non-numerical risk analysis there. Are they doing this just to look good PR-wise and say, hey, we're doing this in the market because we're building these, we're being a sustainable engine that requires no carbon-free? What's driving this decision? How much is energy? Yes, the main part of this analysis is crunching the numbers, finding which product and either both products are profitable. But also, how much is energy play, the importance of energy situation play in this regard? You might find that your internal rate of return is 10%. That's not a very good NPV or a very good profit margin over your cost of capital, which is, and you might say, is it worth it spending all this time and money to earn a measly couple of percent in profit? Well, if the energy importance is paramount to your market and to you, you're willing to make that investment and get a lower profit because you're getting a niche in the market because of the importance of energy conservation. If that doesn't mean anything to you, then you might want to flag the project. Why am I only making a couple percent on this? This is ridiculous. That's why that question is there. How does the energy importance, a non-numerical review, play in your recommendation? And Peter, you're exactly right. Thank you. You got it, man. Thank you. Good boy. Very good. I'm proud of you. Now you can move on. Now I can move on. Hey, I'll tell you what. I looked at my old records last night of when I was in graduate school. I fought with this too. Don't trust me. I battled with this one too. That's why I get a little chuckle putting into my work, because you guys are suffering the same thing I did 10,000 years ago. Okay, but Peter, you're right. So move forward, please. So again, that importance of energy, that question number one, don't take that too lightly. If you come up with very thin margins, very thin returns, you might say, I'm going to go ahead with this project even though we're not making a lot of money, but we're making a statement in the market that we're taking care of the environment and the energy situation. And a lot of companies make decisions that way. Or, nah, I'm going to play it hardball. I'm just strictly a bottom line guy or bottom line woman. I'm going to say, you know what? We're not making enough profit. The hell with energy. We're going to do something else. Forget this. Both answers are right. Both interpretations are correct. I want to see what you decide as an analyst, as an MBA student. What do you think? And that plays, that's that reason for that first question. How does that play into your final conclusion? Yay or nay? A lot of times, you know, I would love to drive an SUV, the biggest car in the world, or an F-15 truck, but I'm never going to buy one of those. Why? In my ethics, I'm not going to buy those huge monster 11 miles per gallon automobiles because I think that's not right for me. Doesn't mean everybody else shouldn't, and they do. That's my decision. I'm a more sustainable type of conservation person. That's just me. It has nothing to do about anybody else. Doesn't say anybody else is wrong. But that's what I'm looking for, the interpretation of how energy plays in your recommending to Mr. Livingston what they should do about this potential product in a potential market. Okay. That might help you guys a little bit. Because let's say you do a couple of the calculations a little wrong, but you do a great answer to question number one, you're going to get an A, solid A. That's what's going to give you a little bit of a headway into your grade. Yeah, you might drop a little bit in the sensitivity area. You just made a math error. That happens. But if you give a good explanation or a good response to question one, that's going to keep you in the A territory. Trust me. That's a big thing, and that's a good thing for you guys to know about that. Spend a little time on that. Think a little about it. Oh, Mr. Hassey, I can't think about that now. I'm crunching numbers. That's okay. But next week, when you start writing your paper, think about that. That's a big deal. It's going to get you that A, even though you might lose a couple points in the calculations. That's okay. With that solid analysis, that's what I'm looking for. Because remember, the the greatest part of the paper is of the work is graded on your interpretation of the data. Remember, your data might be a little bit off from mine, but if you interpret it the way you should and the way you think, you're still going to get an A. Nothing wrong with that at all. So just keep that in your mind as you go forward. I hope this review session helped everybody. Now I'm going to just sit here, stare at the computer for the next half hour. If anybody has anything to say or any analysis, just for the sake, I sent you an email yesterday. I apologize for being a couple days late, but I posted all your case 4 information, the solutions. Everybody did pretty well on it. And those grades are in. So you know you only have 2 more grades left to post, and I'm going to post the class participation grade on Monday before class, because Monday's a voluntary class. It doesn't mean anything. But I'm going to post the class participation grade, and then all we have is the electrics case, and you have your averages going into this last week. Peter, go ahead and send that to me, okay? That's fine. Now, I might not get at it till tonight. I'm having review sessions all day on all my classes this term. So at noon, I have another review session. At 2 o'clock, I have another review session. At 4 o'clock, I have another review session. At 6 o'clock, I'll be in the bar. So if I don't get to your work until late tonight or probably tomorrow morning, don't feel like I'm blowing you off. I've just got a busy day of reviews with my other classes. So just so you know that. But I'll be here all weekend, and I'll be here Monday night at 6 o'clock. Again, you do not have to be there. You don't get marked down. It means nothing. But I will be here just hanging out. And if any of you have final questions, I'm going to go over the sensitivity issue and scenario issue a little bit more on Monday, so you guys can have that. So don't really worry about that. If you don't want to over the weekend, get your base case done, get your WAC done, and then you can head into that and understand it heading into your risk analysis of scenario and sensitivity. But I'm just going to hang out here. If you're going to just hang out with me and wait for people to ask questions, you're more than welcome. If you have additional questions, sometimes students start crunching the numbers, on their computer while they're online, and if something comes up that you might want to ask me, I'll be here for another half hour. It's now 11 o'clock. So I'll shut up. Here are the answers. Sorry. I'm bad.
Should have made them bigger.
Well, you could get the recording, stop it, and blow it up. Oh my God.
Oh my
God. Get the recording, stop it, take a picture of it, and blow it up. But I had it on there for like a minute.
I saw multiple pages though.
Yeah, I know. I'm only going to show you one. Sorry. You guys are going to do this well. I trust me. I think I've told you this before. Historically speaking, unless some students get so totally frustrated and they say, the hell with this, I'm not even going to post anything, everybody gets A's, A minuses, B plus on this work. I've never had disasters, right? Because the key thing is go over it in these review sessions, try to understand it as you're doing it, and then put it together. That's the key. That's why I'm doing this. I don't want you guys to fly in the dark. I want you to put it together. So don't beat yourself up about this. But it can beat yourself a little bit about it, because you should go through a little hell in getting an MBA. You got to go through a little hell. All right. Now I'll really shut up.